Good morning. This is Axel Merk, President and Chief Investment Officer of Merk Investments with my morning update. And I hear myself that speaker's turned off. So lots and lots of questions about the oil market. Many people are trying to make sense of it, and I'm not going to kind of give you a full trading strategy here. Certainly not. Indeed, I am not giving investment advice. Let me give my disclosure here out of the way as quickly as I can. The futures markets, derivative markets, are not for the faint of heart. They are almost certainly not for most people that are listening. They are a wonderful way to burn money. There is a purpose for these derivative markets, a very important one. But anything I mention here is not investment advice, certainly not for derivatives, certainly not for futures, forward contracts, or whatever it may be. And reach out to us if you want to learn some of these more, but we're not trying to kind of get you lured into any of these. Let's maybe start with the basics. President Trump said it's speculators that were driving the price of oil lower. Well, in the abstract, that is, of course, correct. Every commercial producer needs a speculator in order to hedge their prices. So the speculators, those bad guys driving prices down, they are absolute necessity for a functioning futures market, derivatives market. And not only are they necessary for that, the futures market itself is necessary for the producer to lower their cost of doing business, to lock in a price. And so when it comes to physical commodities, there is a very important purpose that these markets are playing. When you talk about financial markets, you can argue about the economic benefits of some of the derivatives, but for the physical markets, there is a clear economic purpose for these markets. So that's the first thing. The second thing is these are physical markets that deal with physical things in the price of oil. You're dealing with oil. And so notably, any contract that is purchased will have a certain date, or usually in the case of some commodities, including oil, there's a window in which the producer can deliver the oil, and it's very clearly defined where and what is to be delivered, the exact contract specifications. There's usually a range of qualities that can be delivered, and the specific location that can be delivered. And the small print matters when you live in a time when logistics routes are clogged. That the gold futures market, we saw that. But the other thing that matters is storage. Storage capacity is reaching limits that are such that people are worried that you may not be able to deliver it. Today I heard, and I didn't double check that, about 70% of the Cushing, Texas storage facilities are full. And so what it means is that once you deliver the oil there, the person accepting it will have to pay for storage until they figure out how to pick it up. Now, in practice, a lot of these so-called speculators have no intention of ever taking delivery, and so they roll the contracts, which means if they own May oil, they may sell the May oil, and then they buy something further out. And so now, when you hear yesterday, middle of the day, I ran a poll and saying, hey, can oil prices go negative? And I often, when I do these polls, I just put them for a few hours. I don't really understand of these 24-hour polls, so I want to have it closed before market close. Well, gee whiz, a 3 or 4 hour poll, whatever it was too long. Prices were negative before the end of the poll, and asked, could prices go negative? Do you think prices will go negative? Indeed, the lowest print I saw for the May contract was about minus $40. Now, how can that possibly be? It can be because sure, there's a minus $40 price tag for a barrel of oil, but then you have to add the storage cost of storing that oil, and so the total cost is substantially higher than the minus 40. So that's something to keep in mind, and that's part of the reason you kind of see these negative prices. Part of it is that you have some investment products that mechanically have to do certain things and roll things over. And so just one more thing here before I talk about that. When we talk about minus $40 and whatnot, this was a lot about the May contract. And now what happens when you see these things quoted is that a lot of times you have the front month quoted, the most active month quoted, and depending on the quote system you look at, yesterday they may have switched to the June contract. And so some people didn't see those negative prices, and it's really the reference point that is looked at, because the May contract is really not. If I look at my Bloomberg screen, yes, it still shows the May contract, but you would typically see that then move to the next front month in the very near term, and depending on the type of contract. System, you see it a little different there. So that there was some confusion that some people didn't see the negative price. It's just a different contract that was shown. Now, the next confusion was that this morning one of the oil ETFs was halted. Now, we use the word ETF very broadly as exchange traded fund. If you're from the industry and want to be more technically, an exchange traded fund is actually an ETF, is a 1940s Act product which invests in securities, so has a diversified portfolio, typically diversified portfolio of securities, and there are some in the oil space as well, but the ones that were highlighted are actually not ETFs per se. They are so-called ETPs, exchange traded products, which is kind of a grouping name for all kinds of other things that are not your mom and pop mutual fund. In this case, the particular one that was in the news is a limited partnership investing in the actual derivative product, and you don't get a 1099 on that. You get a K1. Not all the ATPs give you a K1, but this particular one does. And the short of it is that this is not your equity product. This is something that's invested in derivatives. You don't have to buy derivatives, but that's what it does. And yes, you better know what you're doing when you buy these products. And again, I am not recommending that you touch any of this stuff because you need to know what you're doing. And so these contracts and these sort of products, and there are different types of products, they all have their way of dealing with this issue that you have to buy a contract, and then when you're at the end of the contract, you have to move on to the next contract to average this out to minimize that so-called negative roll yield, the cost of rolling into the next contract. And so this morning before the opening, one of the prominent ones was halted and said, "Oh my God, what happened? What happened? What happened?" Well, what happened is they were out of shares to issue. And to take a step back here, you need to go into the plumbing of some of these products. If you have an ETF, your typical mutual fund, you have an unlimited number of shares authorized. So when you have demand, you issue more shares. In the mutual fund, you do it at the end of the day. In an ETF, you can buy intraday, but at the end of the day, the market maker can go to a so-called authorized participant, deliver them the cash or the underlying securities, in return get cash, get the shares. If it's not one of these plain vanilla mutual funds, for the most part, it is very similar to process than when a corporation goes public. You register shares to take public, which means you register a maximum number of shares you go public with that you intend to issue, and there's a fee associated with that. And so many of these exchange-traded products register a limited number of shares, and they say, "Oh, when there's more demand, we can pay the extra fee because those fees are not low." And then we are back and we continue as we approach that maximum. We'll issue more shares. What can happen in extreme markets, and it's happened periodically over the years, and a product that was overly popular, or the issuer was asleep at the wheel. It's usually a combination of both a little bit, but that you exceed or you're at the maximum number of shares you can issue. And so what happens is you're not allowed to issue more shares until you go to the SEC, put in an application, and the SEC approves it. In an emergency, they can do that reasonably quickly, but you're ultimately dependent at the mercy of the regulator, and they can pull the application. They ask questions. This can take a day or two. This can take a few weeks, and it's often in between. And so in the meantime, you can't issue more shares, and that's exactly what happens to this one ETF. If the authorized participant wants to redeem shares, that's possible, but you cannot issue new shares. And so for practical purposes, that usually means that the market maker will be hesitant to make as tight a market as historically have done because they can't offload the risk anymore. And if there's more demand, well, it means that those sort of shares are likely to trade at a premium. Again, not an investment recommendation, just telling you that if an issuer runs out of shares in an exchange-traded product, historically shares have often traded at a premium, and that's just natural because there's more demand, and the market makers can't offset their risk by going back to the fund by exchanging the underlying goods in these limited partnerships. It's often cash instead of it could be the derivative contract, but it's often cash. Then in a gold ETF, it's gold that needs to be delivered, for example, but in many ETFs, exchange-traded products and so forth, it's cash that gets delivered. And anyway, that will take care of itself. So all of these things here are very newsworthy. They don't really affect things on most people's daily lives too much. Obviously, many of us were glued to the screen yesterday as we saw the price of crude oil plunge. But ultimately, does it have much of an impact for our portfolio? And, fear not, journalists were all over the place this morning out talking about deflation. Well, in all this negative, we clearly got to have deflation. Now, let's take a step back here. And usually when you have deflation, a deflationary spiral, you have everything shutting down. Well, what we have here is the exact opposite of what's happening. And so that's why I don't buy this deflation story quite yet. If you take oil as an example, and by all means, I'm oversimplifying here. There are many other factors that come here. We have imagine you have a shock economy. A virus hits the globe, and then suddenly nobody buys anything anymore, doesn't drive any cars anymore, and so guess what? The price of oil is going to plunge. But now you have a government that's going to make sure that none of us go out of business. The weakest go out of business, but everybody else has access to a lifeline. We have access to the Fed. We have access to small business loans. We have access to everything. That means we're going to keep producing. Now, again, I said I'm simplifying here. Obviously, a lot of production is taken offline. Part of the reason the production isn't taken offline fast is because it's not that easy. But yes, there are credit lines available. And by all means, some companies have mothballed their fracking things, and others will go out of business probably later, more when their debt is due for refinancing. But let me make this just to illustrate the point, though, because I think there is a grain of truth to that, which is we are overproducing. We're incentivized to overproduce, and guess what? Then prices will be plunging. And when you see the price of oil at minus $40, you know something isn't right. And so why obviously we want to provide bridge loans for certain things, let's keep in mind that the moment we meddle with the markets, there will be unintended consequences. And I'm not suggesting the price of oil wouldn't have plunged if we didn't have the Fed facilities and small business assistance programs and whatnot, probably. But it may well have been exacerbated. And of course, the same thing applies to many other areas. Of course, if it's us getting a loan, it's great. If it's somebody else getting a loan, hey, they're pushing down the price. So let's just keep in mind that when we have these government programs, there are substantial ripple effects that go through the markets. Talking about ripple effects, Wall Street Journal and editorial yesterday, the editorial board is often a bit edgy, and they said, hey, hospitals are at risk of closing down because everybody has been told to cancel elective procedures. And guess what? Elective procedures are highly profitable to the hospitals. And sure enough, it's not just the right-wing folks at the editorial board. Wall Street Journal this morning, the CNN wrote about an actual hospital closure in the rural area because they were running out of money because they couldn't do elective procedures. And so there is a rural hospital where there's no other hospital nearby or anything. And so real lasting damage is done with some of these policies, and I'm not suggesting you should rip off the Band-Aid to open the economy, but all these discussions about opening the economies are crucial. We need to figure out a way to do it prudently, and I trust any of you, if you look around locally, you'll say, all right, well, I'm sheltering in place, but some of the rules, I think, could be relaxed a little bit. Why is a gardener that works on his own not allowed to mow the lawn in some areas, right? The person may not give a paycheck, and what is this all about? Now, clearly, the reason that's the case is because when you deal with a massive economy, you're putting some crude measures in place. But now that these measures have been in place in a while, it is time to get more refined. And obviously, reasonable minds will disagree of exactly how it will proceed. And different regions in the world, different states in the U.S., different counties have different policies, and that's all right. We'll complain about what we don't like, and with that, maybe we'll change something. Another headline today, Oktoberfest in Munich is canceled. Dear to my heart, I was born in Munich. I lived in the U.S. now for about 20 years, well, more than 20 years, I think all my life together. I've lived here. Anyway, there are about 6 million visitors that go to the Oktoberfest each year. To put that into contrast, the Olympics in Tokyo are expecting 10 million visitors. So this is a major event. Obviously, TV rights are less for the Oktoberfest, but hotels and whatnot are suffering. Some of the folks that have some of these exhibits there, that's the biggest money they make all year, and so forth. And this is just a symptom of the sort of things that are happening around the world. And the question is, how something like the Oktoberfest, how can you? I mean, the one thing Oktoberfest, if you've ever been there, is it's extremely crowded. And so, what are you going to do, right? I mean, how are you going to deal with those sort of things? And it's not so easy. One more thing, since we are somewhat saying on the policy and political front, President Trump tweeted last night that he will hold immigration. That clearly appeals to the many of the Trump voters. The question is whether it's also good policy. And let me just say that not every worker that comes into the country is taking a job away from an American. And many that do come here are creating jobs, and indeed, if they're gone, fewer jobs would be created. And so let's see how the actual policy will look, and to see how that will impact things. Just on a practical level, to go back to the lower wage migrant worker, at least, there are already places that have challenges with the harvest, and clearly they can hire Americans and whatnot, hire locally. Just in other places around the world, in India, the Darjeeling harvest, went bust because there was a very limited window. Now, obviously, they're the local workers that weren't allowed to work. In Germany, there was in the news that they had some migrant workers from, I think it was Bulgaria, were supposed to fly in, and then made it to social media that they were all, hundreds of people who were waiting for flights, were put into a small room, obviously not social distancing adherent and whatnot. And so there are lots of challenges as if you have migrant workers, how you deal with that and so forth. And so let me not go into the politics of that, but let's just say the issue is a little more complex. In the tweet, of course, you don't want to reach the complexity, and this was meant to rally the base. So let's just hope that the implication is not going to be too aggressive. Sorry about that. Let me get back here to my phone. So briefly on the markets have been a bit all over the place. You wouldn't know it if you just look at the S&P 500. The S&P futures are currently down 47. Have been bouncing around the lows here. But if you look at the price of gold, it was down 2%. It's now down less than 1%. But if you take the euro, for example, it was down sharply. Now it is up. The news was that the South Korean won was down sharply. Well, if I look at my screen, they're actually in the middle of their range by now. That was because of the North Korean leader apparently being out of public sight and allegedly sick. But lots of things here happening. If one market to point to is the 10-year market. We are testing here the lows that we've had. Let me just pull it up here on my screen. Just a second. Yeah, we did go lower in early March on the 10-year, but we're currently at 56 basis points on the 10-year yield, and so that is something that shows that bond markets have been rallying strongly. The 30 years up a point and 30 ticks. One of the things I've been mentioning on this call is the 3-month LIBOR rate is currently at 111 basis points. Noteworthy because the 3-month Treasury bills are only at 8 basis points. So a huge spread there, which shows that there's still some issues in this market. 5-year inflation expectations are at 61 basis points, so very low. Those historically are highly correlated to the price of oil, which they shouldn't be, by the way. If you go 5 years out, you would think that any short-term issues with oil will be sorted out, but these inflation expectations are often highly related to that. Another area that's worth looking at is the Russian ruble. It's currently down 1.8%, the weakest currency on my board. I have to double check because commodity currency is also low. But the point here is that Russia has not gotten its coronavirus under control. A huge country, very porous as well. And so looking at these various charts, that's been very concerning. Other than that, commodities are weaker today with the general sense that there is a deflationary wave coming about. And if I just look at some other dashboards that I have here, I'm not going to bore you with commodities that I never mentioned yet, as one of them is actually up to date. All right, good. Then I will leave it at that. It looks like it's going to be an interesting day. So fasten your seatbelt in these markets. Feel free to reach out with any questions that you have with the submit question down here. Reading them live is a little difficult for me, but I'll try to address them then either directly answering your email or in a follow-up discussion that I do have. All right. With that, have a great day, everybody, and stay safe and stay healthy. Take care.